So after 3 weeks of GameStop stories, it seems like the game may be stopping, or at least slowing down a little bit. The question remaining is really who made money, and is the market any the worse for wear once this thing comes to a close? My name is Kent Kramer, and this is Foster Group's Financial Perspectives for the weekend of February 6th. Before we look at the GameStop story one last time, let's take a quick look at some news in the last 2 weeks. Most market watchers and economists continue to say that really how their response to COVID goes and our ability to control the pandemic, that's going to have probably the most to do with economic recovery of anything else out there. A new study by Vanguard kind of shed some light on that, and I think gave some good news. You'll see two vectors on the slide here on the picture to the left. You'll see one vector with 2 million vaccinations a day, the other vector with 1 million vaccinations a day. The idea there is if we get to 2 million vaccinations a day, we get the herd immunity basically sometime in early summer. At 1 million, obviously, it's much slower, but if you look at the vaccination progress, last week we were about 1.4 million people being vaccinated per day. And of course, there's additional money and systems being developed every day, so we can expect that number to improve as we go forward. I think we're well on our way to at least getting closer to that 2 million a day. The other thing that economists and market watchers are paying attention to is the stimulus package that's currently moving through Congress, that $1.9 trillion bill that we hear so much about. People are also continuing to pay attention to employment and unemployment. Unemployment rates continue to come down, but maybe not as fast as some people would like. In terms of market response to how things are going, well, if you look at the last week, what you'll see here are some pretty good numbers led by small company stocks. That purple line, almost 8% return in the last week in small companies in the US. The other markets there shown represent the US large company market, stocks outside of the United States, as well as the NASDAQ market. If we look at that for year to date, you see the same story. Small company stocks have done considerably better. They're up almost 13%. Oftentimes people refer to small company stocks as cyclical stocks. They tend to do better when the market and the economy are moving into full recovery. So maybe that's a sign that we're moving in that direction, or at least market participants think that we are. And that's really been going on for almost 6 months. Again, the purple line at the top, US small company stocks up 47% in the last 6 months, compared to around 20-some% for markets around the world. Those 20% numbers are perfectly good numbers for 6-month returns, but you can see what's happening with small company stocks. Very, very favorable, strong returns. But as strong as those small company returns are, they get dwarfed by what happened with GameStop in the last few weeks. You can see again, this is kind of since the beginning of the year, small company stocks up almost 13%, the purple line. But if you look at GameStop, up 246%, even after the most recent decline. You can see why this thing has gotten so much attention in the news. So now that the dust is starting to settle, of course, there are a lot of stories about what actually happened in terms of that GameStop story. And I think there'll probably be books and PhD theses that'll be written on these things for many years to come. But what I like to focus on is, hey, who made the money? You hear a lot of times in stories, we'll follow the money if you want to know what actually happened. Well, one way to follow the money is to look at something called payment for order flow. And I think this is an important part of the story because it talks about why high volume activity is so beneficial to certain brokerage firms or high frequency traders. And I think it also kind of explains some of the narrative in terms of, hey, is there something wrong here with the way the system is working? You'll see the chart on the left. You'll see Charles Schwab, Robinhood, E-Trade, all brokers that we're kind of familiar with their names. People have accounts on those platforms and they trade stocks and bonds in their accounts. What Charles Schwab, Robinhood, and E-Trade and others do is they actually sell the execution of those trades, the matching of buyers and sellers, to wholesalers or market makers or internalizers in what's called a payment for order flow transaction. These high frequency traders, the ones on the right, Citadel, Susquehanna, Virtu, and others, what they're able to do is they're able to go into the marketplace and match buyers and sellers more efficiently and more quickly than Schwab and Robinhood. So Schwab and Robinhood sell the trades to the market makers, who then go out and execute, and they're going to make a little money on spread, and then they're going to pay some of that spread back to the original broker, Robinhood or Charles Schwab. And here's a very simple, you'll see I said oversimplification example of how that might work. Let's say the national best offer on the market is 58.25, and the national best bid is 58. Well, the wholesaler is going to buy that trade, so the payment for order flow, but the wholesaler is able to go out and say, hey, I can narrow the spread. I can find someone who's willing to go 58.10 on the buy and a sell for 58.15. When the wholesaler puts those transactions together in that way, the spread narrows, so it's better for the buyer and the seller. The buyer and the seller got actually a better price than the national best offer. But the wholesaler, for their work in narrowing that spread, they get to keep the spread of, in this case, 5 cents in this example, of which they might pay 2 cents back to the original broker, Robinhood, Charles Schwab, and keep the other 3 for themselves. So just how profitable is this kind of business? Well, let's look at just the transactions related to Robinhood on the days with the highest trading volume in that stock. And I've listed the 5 highest trading volume days in Robinhood, kind of going back in the month of January. And let's just look at January 22nd there, the highest day. 197 million shares of GameStop transacted on that day on all the different brokerage houses. This isn't just Robinhood or Charles Schwab, it's just shares of GameStop trading hands. If the spread on those trades averaged 3 cents, in other words, those market makers or wholesalers were able to narrow the spread to where they made 3 cents per share on the trade, you can see they made $5.9 million on January 22nd just by narrowing the spread on GameStop trades. Now, they're doing this for a lot more securities than just GameStop, but this is just an example of what was going on with that particular security and why there was so much interest and why there was so much money involved. The other interesting thing about this picture is it shows just how much activity was happening in a relatively small company. GameStop has 69.75 million shares outstanding. That means if you could buy all 69 million shares, you could own the company outright. You could basically take it private. On the most active day, January 22nd, 3 times that number of shares or transactions happened in a single day. The average holding period, if you do the math based on that kind of turnover, was 99 minutes. So what you see here is the people who are participating in the GameStop trade, at least a lot of them, they were not long-term investors. They were buying and then hoping to sell shortly after at a higher price and get the profit. Of course, the other people who are making profit on this were the people who were in the payment for order flow market, right? Because they were making money whether the stock was going up or coming down. Every transaction represented, in this case, an example of, let's say, 3 cents a share. The more transactions, the better. So who were the likely winners and losers in the whole GameStop story? And it's certainly not over yet. And as I mentioned, there's going to be a lot of things written about this in the future. But as we just looked at today, the wholesalers and the retail brokerage firms and the payment for order flow, they made a lot of money because there was a lot of people trading those shares, and the more transactions, the more money that was made by the brokerage firms and the wholesalers, regardless of the direction of the stock. You know, some retail buyers made a lot of money if they were early to the game. If they were buying between January 13th and January 28th when the stock price peaked, they likely made some pretty good money if they were able to get out before we saw the back half of the story, which is what happened to the likely losers. Well, the likely losers were certainly the short sellers that we were all reading about in the news, the large hedge funds who established positions prior to January 13th. As that stock took its rocket ride up, those short sellers went further and further underwater, some of them being underwater billions of dollars by the time the stock peaked. Retail buyers, unfortunately, after January 28th were among the likely losers as well. This is the fear in a situation like this. Stock goes up very sharply, gets a lot of attention. People want to get in on it, but they get in on it late. They get on it at the peak. And in a speculative mania like this one, there's going to be a peak followed by a sharp fall off. And you can see since January 28th, that falls have been pretty significant. And people who are buying at the peak obviously were likely lost quite a bit of money. The question for anyone looking at a chart like this is, what kind of investor are you? Are you a long-term investor? You know, long-term investors who owned GameStop back in December, let's say, of 2020 and held all the way through, they're still up over 200% on their position. Being a long-term investor and just trying to ignore all the crazy noise that was going on the last couple of weeks. It bodes well for people who take that kind of approach, even though in some periods of time it can be kind of uncomfortable to sit around and watch that kind of volatility. So while it's been fun and interesting, people have learned a lot of things about short selling and hedge funds, Wall Street bets, all those kinds of things that maybe you hadn't been paying attention to before. But one very important takeaway, I think, is that markets tend to be very robust and they can endure a lot of things. There are a lot of people saying, hey, this is bad for the market, or the market's not keeping up, or there's something bad happening here. that at the end of the day, there were buyers and sellers who were agreeing on a price, and they were transacting shares in GameStop. Now, for a while, that price was being driven up by people who were no longer thinking like long-term investors. They were just thinking, if I can buy now and sell 2 hours later, really speculation kind of a mindset, I can make money. That kind of works, or can work if that's your game. Of course, it can work against you when it starts going down the other side. But if we think about long-term investors, the thing about markets is, while sometimes those prices tend to get irrational, let's say, over long periods of time, buyers and sellers, people who are long-term investors, they tend to drive the stock price back to the underlying value of the company. And that certainly seems to be happening in the case of GameStop. This is a quote from Matt Levine, who writes for Bloomberg. I like Matt. He's got a good sense of humor, but a really firm grasp of some of the intricacies of financial markets. The last phrase I really like: it happens. Stuff goes up and then it goes down. Prices are irrational for a while, but financial capitalism, the functioning of markets, survives. We think that's still true, even after watching this episode of GameStop and other things are going on. It's happened before. It'll happen again. Long-term investors, though, we think are well served by markets made up of companies who are trying to be productive and make money. We hope this has been a helpful kind of educational piece for you. It's been interesting for us to follow as well. If you have any questions, please let us know. There's a lot of ways to contact us on this slide. Also, if you're enjoying Financial Perspectives, we hope you'll share it with your friends. If you have any questions you'd like us to address in the future, please let us know that too. We'd be happy to address them. Thanks for watching. Hope to see you soon. In the meantime, stay safe.